How's it going, everybody? Jay Scott here. I'm the author of the book, Recession-Proof Real Estate Investing: How to Survive and Thrive During Any Phase of the Economic Cycle. In this video, I'm going to break down some of the basics of how the economy works, how we can know that we're getting ready to enter one specific part of the economic cycle, what's known as a downturn or a recession, and how we should be modifying some of our investing strategies and tactics during this part of the cycle to reduce our risks and maximize our investing profits. Keep in mind, what I'm presenting in this video is just a brief overview of what's in the book. There's a whole lot more that we as investors need to understand to navigate the economic cycle. And there are a whole lot more strategies and tactics that we can be using to reduce our risks and maximize our profits during a recession and during all other phases of the economic cycle. We won't be covering all that here, but it's in the book. So if you find this introduction valuable, I hope you'll check out Recession-Proof Real Estate Investing. It's available on the BiggerPockets.com bookstore and on Amazon.com in all formats. With that said, let's get started. Market, economy, cycle. These three words form the backbone of our discussion around recession-proofing your investment business. Now, we've all heard these words, but how do they relate to our real estate business? Let's find out. Market. To understand what a market is, we need to actually take one step back and talk about something called transactions. Now, we all know we live in a very transactional world. Every day, billions of times per day, financial transactions take place between buyers and sellers. Buyers give money in the form of cash or credit to sellers who, in return, provide a specific good or service. For example, I might give cash to a restaurant for food, or I might give cash to a car dealership for a new car. I might use credit in the form of a bank loan to purchase a house. These billions of transactions per day are based around many thousands of different goods and services. Now, a market is simply the aggregate of all the transactions around one of these specific products or services. So, for example, the automobile market is simply the sum of all the transactions that involve automobiles. The gold market is all the transactions that involve buying and selling gold. The real estate market is simply all the transactions that involve real estate. And as you can probably guess, the stock market is just made up of all the transactions that revolve around buying and selling public stocks. There are literally thousands of these markets. Many you might expect, but some you probably don't. For example, the corn market, the wheat market, the pork market, and the oil market, the cell phone market, the personal computer market, the software market, the residential housing market, the commercial housing market, and the multifamily housing market, as well as millions of other markets for any other good or service you can possibly imagine. All of these markets put together is what we call an economy. So, to recap, the economy is made up of all of these markets, which in turn are made up of billions of transactions. When we talk about the economy, we're simply talking about the sum of all of these transactions within all of these markets. Now, as you might expect, the number and the size of transactions that take place every day across all these markets isn't always going to be the same. There are going to be months and years where there are more and bigger transactions that tend to take place. Now, when we see more and bigger transactions over some period of time, we typically refer to the economy as strong. Then there are going to be times when there are fewer and smaller transactions taking place. During these periods of time, when there's less money flowing through the markets, we typically refer to the economy as weak. Now, there are a number of economic factors that have to come together to make an economy strong. Then, over time, those same factors that led to the strong economy will cause issues that weaken the economy and push it down. And eventually, those same factors will conspire again to cause the economy to get strong. This pattern of strong economy leading to a weak economy, leading back to a strong economy, that's what we call a cycle. One period of economic strength and growth, leading to a period of economic weakness and contraction, and then leading back to another period of economic strength and growth, is what we refer to as a single economic cycle. These economic cycles happen regularly. In fact, we've had 33 of these full cycles over the past 160 years. 33 cycles in 160 years? Simple math tells us that the average cycle lasts about 5 years. Did you realize that? You probably haven't. But on average, we have a recession in this country every 5 years. Now, we typically refer to the growth part of the cycle as an expansion. That eventually hits a peak and leads into a slowdown, which we refer to as a contraction, which eventually hits a bottom and leads into the next expansion. Today, we're going to focus on this middle section, the contraction. This is also commonly referred to as an economic downturn or a recession. Investing during this phase of the economic cycle can be tricky, but if you make some good decisions and structure your business correctly, not only can your real estate business survive this period, it can thrive. Before we talk about how to adjust our strategies and tactics during a recession, we first need to talk about how we even know that we're entering this phase of the economic cycle. Now, there are a number of qualitative and quantitative measures we can look at that will let us know that a recession is approaching or has already arrived. By qualitative, we mean those indications that aren't necessarily measurable, but they resonate with our feelings and our emotions. They can be just as valuable as quantitative measures, which are the ones that are based on actual data and statistics. Now, some of the qualitative indications that we're approaching or we're in a recession are as follows. The first one I like to look for is what we refer to as desperation selling. Again, there are no numbers behind this. This is just something that you'll recognize when you see it. But as we move into the recession phase of the economic cycle, we start to see sellers getting desperate to sell their houses. They're seeing that the economy's changing. They're recognizing that this could be the last opportunity that they have to lock in the equity that they've built in their properties over the past several years. And they're just looking to get out before their homes drop in value. We start to see a lot of housing inventory hitting the market during this time. We see sellers who are willing to chase prices down and do whatever it takes to get their houses sold. Sellers are starting to get scared, either because they're forced to sell, they're in a bad financial situation, or they just recognize that this is the last opportunity they're going to have to capture some of the equity that they gained during the last expansion. Next, we start to see lending getting tighter. This may be a gradual change, or it may be very, very sudden. From an investor standpoint, we may start to see portfolio and commercial loans getting tighter. We may start to see hard money loans getting a lot tighter. A lot of portfolio and commercial lenders don't want to lend to flippers anymore, and neither do hard money lenders. And so they're slowing down their businesses. Additionally, we may start to see tightening in the conventional lending space. FHA, VA, conforming Fannie and Freddie loans, all of these start to require higher credit scores, they start to require larger down payments, and they start to get more serious about verifying income and verifying borrower assets. So it gets harder not just for you as an investor to buy properties using loans and using leverage, but it's also harder for your customers, your buyers, to buy these properties from you. And because we see this difficulty on both sides, difficulty from the buying standpoint and difficulty from the selling standpoint, it gets really tough for those investors who make money by buying and selling properties to continue to profit during this part of the cycle. Now, those are just a few of the qualitative indicators we see when we're entering or we have entered a recession. Now, let's jump into some of the quantitative measures that we can look at to know that we're in the recession part of the cycle. The first and the most obvious is a drop in what we've referred to as gross domestic product, or GDP. I say that's the most obvious simply because that's the government's formal definition of a recession. When the government sees 2 quarters of a slowdown in GDP, which is the total output of the economy, that's typically when they declare we're now in a recession in this country. Next, housing inventory increases to greater than 6 months. Leading into a recession, we start to see housing inventory increase. And once housing inventory crosses that 6-month mark, we generally see a reversal from a seller's market, which is a real estate market that's beneficial to sellers, to a buyer's market, which is a real estate market that gives buyers an advantage trying to buy property. Depending on how bad the recession is, we might top off at 6, 7, or 8 months of housing inventory at the worst part of the recession. Or if we have a really bad recession, that number could hit 12, 14, or even 18 months of inventory in some markets. In fact, after 2008, there were several markets around the country that saw 14, 16, and 18 months worth of inventory. That's a year and a half of housing. In other words, it would take a year and a half to sell off all that inventory at the average number of transactions that are currently taking place. Next, we start to see a spike in pre-foreclosures, something we often refer to as 30, 60, 90-day lates. The government measures when people are 30 days late on their mortgage, or when they're 60 days late on their mortgage, or when they're 90 days late on their mortgage. And as these three metrics start to rise, that's a good indication that people are having trouble paying their mortgage or choosing not to pay their mortgage. When we see 30, 60, and 90-day late payments spike, that's generally an indication that we're either heading into a recession or we're strongly in the midst of one. And to go along with that, we'll generally see an increase in foreclosures. Depending on what state you live in and their foreclosure laws, those 30, 60, and 90-day late payers may translate into foreclosures either sooner or later. In some states, after 30 or 60 days of missing your mortgage payments, it's easy for a lender to declare foreclosure and start the foreclosure process. But in other states, it takes a little bit longer to start and get through the foreclosure process. So while the 30, 60, 90-day late payers don't necessarily translate directly into the number of foreclosures, they're a very good indication of how many foreclosures we're likely to see in the very near future. Next, we may see home prices falling. In some markets, we may see a modest drop in house prices, and in some markets and in some recessions, we may see a major drop in house prices. Now, we don't always see home prices drop precipitously during a recession. In fact, during some recessions, we see prices level off or even increase, but it's not uncommon to see a drop in values in many markets during most recessions. Next, we start to see appraisals coming in low. Banks are starting to be more diligent about how they're valuing properties. They recognize that prices may be dropping. So if your home was worth $100,000 yesterday, the bank may start to get concerned that your home's only going to be worth $90,000 tomorrow or $80,000 next month. And to account for the fact that your home price may drop throughout the recession phase, banks will often devalue their appraisals. Next, we often see an oversupply of new construction. This is what a lot of you probably saw if you were paying attention after 2008, especially in markets that saw strong growth in 2005, 6, and 7. Developers recognize that they're not going to be able to finish out their subdivisions or their new construction before we hit the downturn, and they may simply just stop construction. In some cases, they'll hand the property back to the bank. In some cases, they'll try to hold on to it. In some cases, they'll just sell it off. Finally, during many recessions and in many markets, and again, this isn't necessarily going to apply to all markets and all recessions, but during a lot of recessions and in a lot of markets, we're going to see a decrease in market rents, and we're going to see a decrease in occupancy rates, especially in the A-class and the B-class properties that were focused on the high-earning tenants who may lose their jobs or see a reduction in hours or wages. Many of these renters will downgrade their housing, moving from A-class to B-class or B-class to C-class to save money. These are the measures that we often use to determine that we're either heading into a recession or we're squarely in the midst of a recession. And this is important to know, but what a lot of us are probably really wondering right now is, how do we make money during this time? In the world of real estate investing, we often talk about strategies versus tactics. Strategies are the high-level niches that are most common in this business. Things like flipping houses, buy and hold, wholesaling, notes, lending, self-storage, etc. Tactics, on the other hand, are the specific implementation of those strategies, the day-to-day decisions we make to ensure that the strategies we're using will allow us to reduce our risk and optimize our profits. For example, a common investing strategy is wholesaling. Now, a lot of people think that wholesaling doesn't work well during a recession. And to a large degree, they're absolutely correct. But just because the strategy in general doesn't work tremendously well during a downturn, doesn't mean that there aren't tactics within the wholesaling strategy that do work. Specifically, one common tactic that works well for wholesalers during a recession is selling to landlords as opposed to investors or retail buyers. During good economic times, wholesalers typically focus on house flippers as their primary customer. That's because it's house flippers who are buying the most distressed properties when the economy is strong. But when the economy starts to turn, house flippers tend to just sit on the sidelines or adjust their strategies to something other than house flipping, which makes it really difficult for wholesalers to continue making money selling to flippers during these tough economic times. Now, when the market turns, there are typically a whole lot of buy and hold investors, residential landlords, for example, who've been sitting on the sidelines for months or maybe even years, waiting for more affordable properties to come along. They often have cash, and they're eager to pick up cheap properties. And because these landlords aren't planning to resell the property anytime soon, they don't care if the market's still dropping, and they don't care if they're not buying at the very bottom of the market. Good wholesalers will focus on finding properties that suit these buy and hold investors and will work to build a buyer's list of these landlords during tough economic times. This is just one example of how wholesalers can modify their tactics during a downturn to reduce risk and optimize profits. There are many more. But for now, let's turn our attention to house flippers for a minute. While flipping houses during a downturn isn't the best strategy to pursue, there are ways to ensure that you're making the highest profits possible with the least risk, if that's the strategy you choose. A couple tactics that work well for flippers during a downturn. First, make sure you buy in great school districts. Data indicates that prices tend to fall less in good school districts, meaning you'll have the largest pool of buyers and the most opportunity to capture the highest resale price if you're selling in these areas. Second, focus on properties at the median price point in your area. For example, if the average house in your area sells for $300,000, you shouldn't be trying to flip a $700,000 house or a $50,000 house. Data indicates that houses well above or well below the median price point tend to slow faster and more drastically during a downturn. This is because buyers in these price points are more at risk of losing their jobs and find it more difficult to get financing for the purchase. There are a lot of other tactics that house flippers should be considering when continuing to flip during a downturn. But for now, let's turn our attention to buy and hold investors. What can a residential landlord do during a downturn to reduce risk and preserve profits? Here are a couple tips. First and foremost, focus on C-class properties. During a recession, we often see rents and occupancy rates drop in A-class and even B-class properties. This is because renters are losing their jobs and seeing a reduction in hours and wages. They're looking for smaller, less expensive housing and will often move down in housing class. But everyone needs a place to live. And because C-class housing will generally give the best bang for the buck for renters, it tends to hold up the best. In fact, in many areas around the country back in 2008, C-class housing outperformed the market. Rents continued to climb and occupancy rates increased. Second, you should consider college housing. A little-known secret is that during a recession, college enrollment actually increases. This is because a lot of people can't find steady work, and they decide that now is a great time to go back to school and add some additional credentials and skills. Landlords in college towns often find that finding and keeping tenants is a lot easier and a lot more profitable than in other locations. Now, there are a lot more tactics that buy and hold investors should be considering when buying and holding during a downturn. But for the time being, let's turn our attention to commercial investors. If you like commercial real estate, there are some tactics that you can employ during a recession that will tremendously improve your chances of success. A couple of them include self-storage. During a downturn, people tend to downsize their houses, but they don't downsize their stuff. So we typically see increased demand for self-storage during a downturn. Also, medical centers. If you're a commercial investor looking to buy commercial space, consider medical offices. Medical services tend to be very recession resistant, so you can be confident that your tenants will continue to pay their rent and renew their leases. These are just a few of the tactics that wholesalers, flippers, landlords, and commercial investors can use during an economic downturn to reduce risk and increase profits. But there are a whole lot more. And if your preferred investing strategy is note buying or lending or multifamily or anything else, there are lots of tactics that you can employ as well. If you want to learn more about these tactics, about the strategies and tactics that work well in other parts of the economic cycle, and about how the economy and cycles work in general, I hope you'll check out my book, Recession-Proof Real Estate Investing. Thanks so much for tuning in. Now go recession-proof your business today.